Are we on the verge of a market collapse?
We've gathered insights from financial experts like Bill Smead and George Gammon just for you.
And the best part? You'll learn the key points quickly without wasting time.
Exactly. Find out why the Chinese real estate market could be a ticking time bomb.
Welcome to Financial Insights in Minutes, your source for quick financial insights.
Stay tuned for our next video where we dive deep into inflation risks and investment strategies.
First up, let's listen to George Gammon's alarming take on the world's largest asset class at risk of collapse. Today, we're delving into George Gammon's alarming assessment of the world's largest asset class, the Chinese real estate market, which is on the brink of collapse.
Absolutely. With a valuation exceeding $60 trillion, the consequences of a downturn here could shake global markets.
Can you break down Gammon's main thesis regarding the Chinese real estate collapse?
According to him, the staggering drop in this asset class, which constitutes 70% of household wealth in China, poses severe risks to economic stability.
That's a significant percentage. What does that mean for households?
It translates to an incredible $18 trillion loss in household wealth, which directly impacts purchasing power. Think about how that mirrors our own housing crisis.
Let's get into the specifics. What's been happening in the Chinese real estate market?
Prices are down significantly. In fact, they've experienced a decline similar to the U.S. housing crisis back in 2007.
How are these declines affecting other economies, particularly the U.S.?
There's a high probability that these issues in China could ripple through to the U.S., especially with our own struggles in commercial real estate.
What are some indicators showing the state of the Chinese economy?
Records indicate a dangerously low GDP growth rate of just 7%, alongside increasing unemployment. These trends are certainly concerning.
So looking ahead, what are the predictions for the Chinese economy?
Gammon fears we are headed straight for a recession, which could further exacerbate issues in the U.S. and beyond.
What are the final takeaways from this analysis?
Gammon's critical message is clear. Understand these risk factors and prepare for potential market retractions globally.
Today, we're diving into pressing issues affecting the stock market, namely rising bond volatility.
That's right. As we move forward, an increase in bond market volatility might signal a market pullback.
What's the central thesis here for our viewers?
As bond market volatility rises, historically, the stock market tends to decline, a trend we're closely monitoring.
That's intriguing. Is there evidence of this correlation?
Absolutely. We've documented a historical correlation, and current rising yields put us on alert.
First off, the MOVE index is at one of its highest levels in years, indicating potential trouble.
Exactly. When this index rises, it often means the stock market is under pressure.
The CNN Fear and Greed Index shows we're in extreme greed territory, which isn't an ideal sign.
Right. In the past, similar readings preceded significant market pullbacks.
How do rising Treasury bond yields factor in?
The jump from 3.6% to 4.2% pushes investors to reconsider their stock allocations.
Could we see corrections like we had in 2022 if bond yields continue to rise?
That's a possibility. History shows rapid yield increases lead to market rebalancing.
What historical instances should investors consider?
Past instances demonstrate that sharp yield increases can trigger corrections. Similar patterns are arising today.
How do you predict the market will react if these trends persist?
We could see the S&P 500 dipping back towards 5,600 if current pressures remain.
Amid all this caution, are there still opportunities?
Definitely. We're preparing to buy into dips when they arise, just like our previous strategies.
What's the final takeaway for our viewers today?
The key is to remain cautious. Monitor the market dynamics closely for the right opportunities.
In today's analysis, we're examining the implications of the Bank of Canada's recent decision to cut interest rates by 50 basis points.
This isn't merely a local move. It's part of a global trend of central banks responding to economic pressures.
So what's at the core of the Bank of Canada's recent decision?
The main concern lies with falling consumer prices and disappointing labor market indicators, driving central banks to implement aggressive rate cuts.
Let's start with the rate cuts. Canada's latest move is significant. Why now?
They're reacting to a dire economic situation with consumer prices beneath target levels, prompting immediate action.
The IMF seems to have consistently lowered its projections. What's the reasoning?
They initially expected a recovery post-pandemic, but reality shows a weakened global economy.
How does the labor market factor into this situation?
With hiring intentions declining, especially among younger cohorts, consumer spending is under pressure.
Indeed, rate cuts are often considered solutions, but are they genuinely effective?
Not at all. Historical evidence shows they fail to address deeper economic challenges.
Should we expect more rate cuts globally?
Yes, if economic pressures escalate, we'll likely see this trend continue.
And what about the risk of a recession due to these trends?
There's a substantial risk of recession if the economy doesn't stabilize soon, especially with ongoing supply shocks.
What should viewers take away from this analysis?
Maintaining a level-headed approach and readiness for market changes is crucial, as central bank strategies can only do so much.
Today's topic is rather alarming: Wall Street's sneaky strategies and their significance for investors.
Indeed, it seems every turn may unveil a market trap. Let's unpack this.
What's the central message regarding Wall Street's maneuvers?
The core argument emphasizes retail investors need to stay vigilant. Wall Street's tactics can be deceptive.
So it's about staying one step ahead.
Absolutely, a proactive mindset is vital to avoid being trapped.
Let's investigate how Wall Street maneuvers can distort true market conditions.
Exactly. They frequently hire experts to fabricate narratives that may not reflect reality.
What about retail investors? How do they fit into this picture?
Retail investors often react emotionally, leading to unwise decisions amidst market volatility.
How can investors protect themselves?
Education is paramount. Comprehending market dynamics allows for smarter decision-making.
Is there a specific approach investors should adopt when analyzing the market?
Yes, focus on data-driven analysis to discern genuine trends.
What signs should investors monitor?
Key indicators like unusual trading volumes or sudden price shifts should never be ignored.
What predictions can we expect moving forward?
Prepare for increased volatility as market corrections could succeed sudden peaks.
Sounds like a turbulent ride ahead.
Absolutely. Investors should brace for potential shakeups.
What should investors prioritize in the meantime?
Risk management will grow increasingly critical as uncertainty looms.
Smart investing equates to strategic planning, right?
Precisely, a solid plan can act as a buffer against market shocks.
To summarize, what final thoughts should investors keep in mind?
Awareness and education are key. Don't let Wall Street lead you into a pitfall.
Wise advice. Staying informed is indispensable for anyone in the market.
Indeed, it's about striking a balance between caution and opportunity.
Today, we're diving into market insights with Bill Smead, who's candid about his perspectives.
Absolutely. With the relentless rise in stock prices, it's crucial to analyze what's happening beneath the surface.
So, Bill, what's the core of your thesis today?
At the heart lies the idea that we're entering the late stages of a financial euphoria, historically pointing to an impending market correction.
That's a bold claim. What's the evidence supporting this?
Just examine the landscape. Market participation is at all-time highs, indicating that many investors are overly optimistic.
You mentioned overconfidence as a concern. Could you elaborate?
Certainly. Historical data reveals that when everyone feels invincible, it's usually time to exercise caution.
What's the story with current stock valuations, especially in tech?
They're disproportionately high right now, suggesting potential vulnerabilities that could lead to corrections.
How do rising interest rates factor into your forecasts?
Higher rates typically constrain growth, and with inflation returning, it complicates matters.
How do demographics influence your outlook?
A growing population demands homes and essentials, driving up inflation and economic activity.
If we are heading for a lost decade, what steps should investors take?
Focus on undervalued sectors and remain agile. Real assets and solid fundamentals will be vital.
What predictions do you have for the market moving ahead?
I foresee significant challenges for investors regarding growth, echoing themes from past decades.
Inflation appears to be a recurring theme. Why do you believe it will resurface?
As more people require basics, rising costs will naturally follow.
To conclude, what key takeaways should viewers absorb from this discussion?
Stay vigilant, brace for market volatility, and proactively refine investment strategies.
A balanced approach sounds fitting as we navigate these unpredictable waters. What a whirlwind of financial insights we've just explored.
Absolutely. Bill Smead's view on the potential downturn amidst financial euphoria really sets the stage for caution, doesn't it?
It does. And on the flip side, George Gammon painted a rather alarming picture of the Chinese real estate market.
Indeed, those statistics he shared about the collapse could have far-reaching implications for the global economy.
And let's not forget about Jeff Snyder, who linked central bank decisions to our economic landscape.
Right. The interconnectedness he described is critical for understanding market movements.
So, while some areas show signs of distress, it's essential to keep an eye on these global influences, isn't it?
Exactly. If you found this exploration insightful, make sure to give us a like, subscribe, and stay tuned for more invaluable financial content.
You won't want to miss what we have coming next.
Thank you for joining us, and we hope to see you in our next video, where we'll dive even deeper into market trends.